everyone, my name's Deborah and today I'm going to teach you how to find the value of a levered firm. So if you're watching this video, hopefully you know that the price of something today is the sum of all the future cash flows discounted by some applicable discount rate. So the same is true for the value of a levered firm today. The value of a levered firm is the free cash flow divided by the weighted average cost of capital, which we will be using as the discount rate. So the first thing I'd like to talk about is the free cash flow. The free cash flow is basically all the cash that a firm has on hand to pay creditors, stockholders, etc. And the formula is operating cash flow minus any changes in net working capital minus any changes in capital expenditure. When I was taking finance, my professor never really included net working capital or capital expenditure in the WAC problems. So the formula I'll be using today is just for operating cash flow, which is EBIT times 1 minus T. EBIT, of course, is your earnings before interest and taxes. So essentially your free cash flow, when it's just operating cash flow, is your after-tax earnings. And of course, if you don't know, the EBIT is revenue minus any cost of goods sold minus your operating expenses, and T is the corporate tax rate. So the next thing that I like to discuss is the WAC, or the weighted average cost of capital. Unfortunately, this isn't as easy to find as the free cash flow just because there's so many more components that are involved. So I guess I'll show you the formula, which is the cost of debt times the weight of debt times the 1 minus T, which is a tax shield because debt has tax benefits that equity doesn't, plus the cost of equity times the weight of equity plus the cost of preferred stock times the weight of preferred stock. So of course in this equation, R will be your rate or your return or the cost. It really just depends on the context of the question. Weight is the weight of the value, whether it's debt, equity, or preferred stock, relative to the entire market value of the firm. D is your debt, E is your equity, but this is actually just common stock because preferred stock is down here as P. So after you have this down, I guess I'll go ahead and talk to you about how you find all of these different costs. So the cost of debt is basically the interest rate that the firm would pay if it had to borrow more money today. And because it's this simple, you can just find it indirectly for a really good estimate. So for example, if you know that every single time that the company has issued bonds, the yield to maturity was X percent would be your cost of debt that you could use. The next thing that I want to talk about is the cost of equity. So the cost of equity has a formula. You can actually find it a couple different ways, but we were taught that this was the most effective method. And so the formula is the risk-free rate plus the beta of the equity times the market risk premium. So the risk-free rate, like the cost of debt, can be observed indirectly. In a perfect world, the risk-free rate would be associated with some kind of asset that you could buy that would have no risk to it whatsoever. Of course, we don't live in a perfect world, but in practice, we use the rate of the T-bills just because there is very little default risk. And so I guess if you're watching this video, you probably already know about unsystematic and systematic risk. If you don't, I'll give you a quick recap. So unsystematic risk is any type of business risk. So for example, if you want to invest in some kind of company where they primarily hire from unions, you run the risk of, seeing a strike or seeing expenses that are related to the strike. So it's risk that is not applicable to the entire market. It's either for like a certain company or a certain industry, just a small subset of all of the stock. And the next thing is systematic risk. Now, this is something that does affect the entire market, but it affects assets differently, depending on, what company they are and what precautions they have in place. But essentially, the systematic risks are things like changing interest rates, a recession, a war, some global catastrophe. And this is what we pay attention to because unsystematic risk can be diversified through a portfolio and you can just completely get rid of it. But when we take stocks and assets and whatnot into account, we do want to look at how it reacts to systematic risk relative to the rest of the market. And to do this, we look at the firm's beta. So the beta is the volatility that the equity has or that the firm has. And again, this volatility is a measure of its systematic risk relative to the entire market. And then the final part of the cost of equity is the market risk premium. So the market risk premium is actually made up of the return on the market minus the risk-free rate. So basically what this does is it shows how much of an excess premium you would require to move your money from a risk-free asset to a more risky one. And the market risk premium is the same for every single stock in the market, simply because the risk of the market or the return on the market is an average. And of course, the risk-free rate is a T-bill rate. So no matter if it's firm A or firm B or firm C, they will all have the same market risk premium. And then the last cost is, of course, the cost of preferred stock. And this will just be a perpetuity formula, because preferred stock basically just gives you a dividend every year. It promises that. So it'll be the dividend divided by the price of the stock today. So that's pretty easy to figure out. So lastly, I guess we should talk about the weight of everything. So earlier I told you what D, E, and P mean, but now we know that this formula, the value of the levered firm, equals all of these summed up. So if you actually have the market value of debt, equity, and preferred stock, of course, this could be found by multiplying the number of bonds or common stock or preferred stock by the price it's trading at right now. You wouldn't have to go through this whole process of finding the WACC. You would just be able to add up all the values and get the value of the levered firm there. But of course, if you don't have all that and you do just have the weights, just know that the weights are basically D, E, or P divided by the value. And so that's pretty easy. And I guess now if you want to see the entire formula put together, the value of the levered firm would be EBIT times 1 minus T minus changes in net working capital minus changes in capital expenditures divided by this huge long WACC formula that we just went over. So I know that was a little fast, but if you think that you have it, I have an example for you to try. So imagine there's a firm with a yearly revenue of $10 million, yearly cost of goods sold of $6 million, yearly operating expenses of $1 million. It belongs to the 35% corporate tax bracket. The yield to maturity on every bond issuance that they've had has been 5%. The T-bill rate right now is currently 1%. The beta of the firm's stock is 1.5. The market risk premium for their competition is 5%, and the weight of debt is 60%. And there is no preferred stock in this. And using this information, you can find the value of the levered firm, and that's what I would like for you to do. So if you want to go ahead and put this video on pause and try to work it out yourself, after you unpause it, I will go ahead and tell you the answer and how you can actually find it. Okay, so hopefully you have given this problem a try. I guess I will start out by telling you what the answer is, just so you can see if you got it or not. The answer to this particular problem is 36,448,598 and 13 cents. So how did I get that? Well, I will include a link to the spreadsheet that I used to get this down in the info section. If you want to click along now to follow along while I explain, that might be good. So I gave you all of the components of EBIT. So revenue, cost of goods sold, operating expenses, and you can get an EBIT of $3 million from that. Because I never mentioned net working capital or capital expenditures, you would just assume that there were none. And I gave you the tax rate. So after that, you can plug EBIT and the tax rate into the free cash flow formula we talked about earlier to get a total of $1,950,000. Next, of course, would be to calculate the weighted average cost of capital. So I gave you the cost of debt indirectly, albeit. I told you that the yield to maturity on previous bond issuances were 5%. And you can also get the components to find the cost of equity through the formula we discussed earlier, because I told you the T-bill rate is 1%, like we discussed. This is the risk-free rate. I told you the beta is 1.5, and I told you the market risk premium for their competitor is 5%. Well, like I said earlier, the market risk premium is market-wide. So this would also be the market risk premium for this firm. And so using that, you can get a cost of equity of 8.5%. And then, of course, the weights of debt and equity were also kind of given to you. I gave you the weight of debt, and to find the weight of equity, you just subtract the weight of debt from 1 because I told you there was no preferred stock. So after all of that, you plug that into the WACC formula and you get 5.35%. And then after you plug all of that into the original formula, you get $36,448,598.13.